Afternoon, everyone, and welcome to the session on central bank digital currencies. My name's Jumana Saleheen. I'm Chief Economist Europe for Vanguard Asset Management. I'm delighted today to have a very well-known panel of people. So sitting to my right is John Cunliffe, Deputy Governor Financial Stability at the Bank of England. We've got Cecilia Skingsley, First Deputy Governor Monetary Policy at the Sveriges Riksbank. We've got George Selgin, Senior Fellow and Director Emeritus from the Centre for Macro and Financial Alternatives at the Cato Institute. And we've got Raphael Auer from the BIS Innovation Hub, Head of the European Systems Centre. And of course, Cecilia will be joining the BIS later this year, but today she's speaking in her capacity as a central banker. So welcome everyone, and we're really looking forward to your comments today. Just to let people know, the structure that I'm going to follow today is we're going to kick off, dive right in to questions to the panel. And we're going to do that for about 40 minutes. And after that, we're leaving 30 minutes for questions from you guys. So there'll be plenty of time for audience participation. So I want to kick off with a really important question. And Cecilia, I would like to start with you. And my question really is, why are so many countries in the world trying to build a central bank digital currency? In the language of the recent House of Lords Economics Affairs Committee report in the UK, to what problem is a CBDC trying to answer?
Okay, so thank you very much, Jumana, and good afternoon to you all. It's a pleasure to be here. So central banks, as you mentioned, central banks across the world is looking into this, somewhat for different reasons, but the reasons all rhyme. And the common denominator here is the digitization of societies, which takes a number of different shows itself in a number of different ways. And for central banks, I think this has opened up quite a fundamental issue around what is money, how do you provide money that is safe and efficient and provide us a stable store of value, how do you keep payments being safe and efficient and inclusive. Going back to the House of Lords, let me try to give you sort of an elevator pitch of why I think this is an important part. In a future where cash no longer works as an easy access to a store of value and a payment method, CBDC is really nothing else than the next technical version of central bank money, making sure that there is integrity in the monetary system and that we maintain the sort of general trust in it, and it's protected for all time. And this takes quite a bit of forward looking. You have to think about what it looks like in the future where cash no longer works, and then think about what you need to do today to manage that future. I don't know how forward looking the House of Lords is, but I hope that they will at least take that kind of stance in their next report on the subject.
Thank you very much. So George, do you agree it's the decline of cash looking into the future?
Well, not exactly. The decline in the use of cash, of course, is a result of the availability of other substitutes. It doesn't happen simply because people have no choice. In Sweden, it's happened quite a lot because they have good substitutes for cash already, presumably. There's no risk that cash will disappear on its own and people won't be able to use it unless central banks actually stop making it available. So I don't think that the fact that cash is going out of use, or looks like it's tending to go out of use itself, provides a motivation for other currencies as opposed to being a response to the availability of other means of payment. That doesn't mean that I don't think there might be some advantages to digital currency as a substitute for cash, and that it doesn't mean I don't think it's worth exploring the possibilities for such currency. But then I would add, and I suppose I'll say more about this later, but I think that any innovations that central banks might achieve in this area could be better achieved and implemented by the private sector if it were allowed to do so, if it were allowed to have access to the central bank settlement and other facilities, and of course if it were properly regulated to keep it safe.
Thank you, thank you. So, you know, a little bit of a difference of view there. So, John, I wondered if you could help the audience to understand the distinction between a retail central bank digital currency and a wholesale central bank digital currency.
Well, thanks, and thanks for the opportunity to speak. The bad news is I'm recovering from a bout of COVID, and I may cough as I go through this. The good news is I've been testing negative for 3 days now, so you're all completely okay. Well, the tests are pretty accurate most of the time, so that's fine. And look, I heard what Cecilia said about the House of Lords, and she can say that, and I couldn't possibly comment. But just to address your question. So the simple difference is a retail CBDC is for use by households, ordinary people, for their everyday transactions in the way they use cash. So think of it as a digital form of cash, although cash is an asset issued by the central bank as a bearer instrument, and I think it's very unlikely that any of us would issue a retail CBDC as a bearer instrument. It would probably be some form of account-based instrument. Wholesale CBDC is really for the financial sector, for the economic transactions between the financial sector. So that's the high-level definition. But behind it, actually, I think there are some interesting questions about motivation, and this may just get into some of the things that have just been discussed. So in shorthand, I think, and everyone sees different motivations, and I won't go into the geopolitical ones, but I mean, two of the big motivations, potential motivations for a CBDC, and you know, people can argue about this, is one is as cash disappears, and it disappears because it's no longer fully functional money. You just can't use it in everyday transactions in the way that you used to. So as the use of cash goes down, basically public money, state-issued money in the hands of the citizen disappears. And one argument for a retail CBDC is it puts that safe asset back in the hands of the public, and that will serve a purpose in underpinning confidence in money, and that will serve a purpose in underpinning uniformity of money, because any citizen can take their commercial bank money or their private stable coin and be required to convert it into the digital central bank money in the same way that you convert your bank account money into state money every time you go to the ATM and withdraw cash. Now, we can argue about whether we actually need something in the hands of the public to anchor confidence in money and to create uniformity, but that's one set of arguments. The other set of arguments are more on the kind of benefits side, which is as the economy becomes more digital, if we can tokenize in some way, I use that word, central bank money, cash for people, it can be built into digital functionality. Think smart money, think programmable money. People can actually take the transfer of value, which is what you do when you pay for something, and integrate it into an algorithm so that it's automated, and then it just becomes part of your digital life, part of your social media. The money is fully integrated. And I think we're going that way. The question is whether it should be a publicly provided asset that can do that, or a privately provided asset. If I think about wholesale CBDC, the simple answer is we provide electronic money for the banking system already. The banks have, in the UK's case, accounts at the Bank of England. They exchange their claims on the Bank of England across our real-time gross settlement system. So they don't need a digital central bank asset. They already have that. We have that, and that is basically the backbone of the payment system in advanced economies. So that argument isn't strong, but the argument around functionality, being able to tokenize, being able to have instantaneous transfer, instantaneous safe transfer of value, that's a very powerful argument in wholesale, because you can not only tokenize the settlement asset, otherwise known as money, the value you transfer, you can transfer the thing you're buying. So this could be payment versus payment in a foreign exchange transaction, but this could also be delivery versus payment if you're buying equities, if you're buying bonds, if you're buying a house. Okay, basically the whole thing can be automated, and you don't have to have an intermediary to ensure that the person who pays the money gets the asset and the person who sells the asset gets the money at the same time. All of that can be integrated into the algorithm. You know, the fashionable word for that is DeFi. But basically, it is creating, if you like, the settlement transfer within an algorithm that takes out all of the intermediaries and reduces costs. And I think there the advantages are really around efficiency, cost, and actually developing new sorts of service. So my own view is there is a powerful argument for both of these things. There are many routes to Rome, and the route that most central banks are thinking about for the retail side is not that we would produce the asset, produce the rails on which the payment happens, and interface with the public. It's that we would produce the asset and the rails, but the interface with the public would actually be done by private sector payment providers, could be banks and the like, who would have the customer accounts and who would be able to integrate our tokenized central bank money into their digital applications. I think there are other models. One model is that we allow the private sector to do the tokenization and provide their own money, but we back it one for one with central bank money, which is the synthetic money I think you were, central bank currency you were talking about. And on the wholesale side, you know, central banks could provide the rails and the assets as they do now, but there are some private sector solutions now where actually the tokenization and the transfer is done by the private sector, and you just synchronize with the real-time gross settlement system and move it across. So where you put that cursor between the public and the private sector in both retail and wholesale, I think those are decisions that people will take on basis of security, efficiency, and the like. But at the moment, all of those things, I think, are being looked at in the sector.
Thank you. So let's just, I just wanted to get a show of hands from the audience, because I think, you know, when we talk about CBDC, retail CBDC, John's just told us very, very different from wholesale. But how many people, if CBDC was offered, would like to have that in their digital wallets? Let's see. There's a lot of people there, or okay, so that's a few. And how many would say, actually, I don't know yet, or no? Yeah. So it almost seems balanced with, I would say, a 30% sitting on the fence right now, waiting for more evidence.
Jumana, do you mind if I just interrupt?
No, please.
So the iPhone came out in 2005. How many people wanted one immediately? Sorry, for those of you that can remember 2005. Okay. If I'd have told you then that the only way you could travel was to have your health records, your airline tickets, your personal locator form on a phone, because you otherwise couldn't travel, and that you could book an Uber or whatever with an iPhone, would more people have wanted it? I mean, the point I'm making is asking people, do they want something that doesn't yet exist and for which the functionality hasn't been developed, is a question where most people, it's difficult to imagine.
Sure. It's difficult to imagine. I guess I was just thinking, you know, we know that in the private sector, people are very much into certain forms of digital currency. Yeah. So just wondering if the thoughts are out there. But at this point, I'm going to move on to get some evidence. So, Raphael, you've done quite a lot of work at the BIS on evidence from around the globe on central bank digital currency, range of design options being considered. Could you tell us a bit about those and what we have learned so far from those pilots?
Thanks for the question. Thanks for having me here, and everybody, thanks in the audience for being here. Let me start by saying I'm going to be speaking on my own account and not on behalf of the BIS. But what I do with my BIS colleagues is stock take really all CBDC approaches that are out there. We really scan all publicized projects. We get in touch with the experts at the central bank to really understand what is it specifically that this central bank is pursuing. And we have a database that we've just updated for the occasion of this conference. It's on the BIS webpage as I'm speaking. And there are now 68 retail CBDC projects around the world and 28 wholesale CBDC projects. There are some very famous pilots, the e-krona one or the EU one in China that has attracted over 200 million users already. And there are 4 live CBDCs, the Bahamas Sand Dollars, the DCC eCash, the Nigerian e-Naira, and the newest one, the Central Bank of Jamaica's JAMDEX. We should be aware that sort of these are impressive numbers and they continue to grow impressively, but in all but these 4 jurisdictions that have issued CBDC, these are really conceptual approaches. So they could be technological approaches or they could be purely paper-based reports that inform the public how a CBDC could look like, right? Because it's like with the iPhone, we're talking about something that in most jurisdictions doesn't exist, and we need to kickstart the dialogue, this big dialogue, and inform it so that it can, result in a good consideration of the benefits and the negative sides of issuance. And with this disclaimer, let me still give you some trends of what we see. The first trend is that the vast majority of CBDC trials are those that involve a substantial role for the private sector. So basically, we could be talking about designs where the central bank, as it does today, really only operates the wholesale side and the retail sector connects with offering all customer-facing business. The second trend is that in terms of coexistence, and this is the strongest trend, there is not a single report that says that CBDC would be a substitute to cash. All argue that there are certain instances, online purchases, where physical cash cannot be used, and we need to find a digital complement to it. But there will be coexistence of physical cash and CBDC, even if CBDC were to be issued. In terms of technologies, early CBDC trials focused on blockchain-inspired, cryptocurrency-inspired technology, but that has shifted over time. It's not swung to the other extreme, but it's much more balanced now, and central banks are considering designs that are based on traditional centralized infrastructure, as you would use when you use your iPhone, right? There's a lot of resiliency in these systems, so data is distributed across the globe, but it's really a hierarchical infrastructure where there's one focal node that sort of coordinates everything, and it's not a DLT where you have different entities that don't trust each other. And last, and I think this is also very important, is that the international focus has really come into the fore. Also as part of the G20 initiative to bring down the cost of cross-border payments. And we have 2 panelists that are very center pieces in that global effort. And so these are sort of the 4 major trends in CBDC issuance. And I want to close by giving sort of one takeaway, and it relates very much to sort of this debate that we have on what is it actually good for. And I want to make one specific example in the context of a number of projects that the BIS Innovation Hub has been running on MCBDC arrangements. So those are arrangements between several central banks that facilitate cross-border payments from one CBDC to another. And I think sort of all these experiments, they show this is technologically feasible. This may bring certain efficiencies, but it comes with a set of government issues on how to design them conceptually, how to operationalize them, and how to operate them together. And the most striking point is about access. So these trials, they involve a jurisdiction that is domiciled in one country getting short-term access in another country, to the CBDC of another country, which makes it easier for them to minimize settlement risks or manage their liquidity in foreign currencies. And now the key point is this. We could do these things in traditional account-based systems. It would just be very cumbersome because every night we would need to, right, for example, in Jura, This is it's a project between Switzerland and France. This is given on an intraday basis, but every night it's netted. And you could, right? You could have somebody who goes through all the accounts of non-resident institutions and nets them each evening, but it would be very cumbersome. It also comes with question of, if my jurisdiction holds foreign CBDC, what is sort of the information I get about this as a central bank? And it comes with a big discussion about how we can arrange the government of this system. And so these MCBDC experiments, they combine all this, right? They are a technology to automatically net at the end of the day. They're operationally simpler than doing that in the traditional account-based system. They come with a new discussion on, well, if I give your institutions or access to my CBDC on an intraday basis, you know, what is our common approach? What are our common standards? And it's clean slate. And they come in a platform where we can agree on the automatic information exchange. So all of this, right? Small, technologically enabled changes to policy discussions that we could have had a long time ago, but that we can have now because we have clean slate technology and because we have systems that can make certain things operational in an easy manner. And I think sort of that's what we need to focus on, not these big discussions, how would an all-encompassing CBDC change the monetary and financial system, but the specific niche cases and where do we see the specific benefits.
Thanks, Raphael. If I could just ask a follow-up question. It sounds like, you know, a lot of efficiency, costs are down, transparency, those are the really good things. Is there anything that we're learning kind of on the negative side?
Well, yes, we have released a report on these 4 experiments, and we're not shy on the negative side, which is that, you know, increasing integration comes with increasing need for coordination, and historically it has been very difficult to coordinate. I want to remind about this, you know, ISO 20022 standard that is supposed to harmonize payment messages around the world, and true to its name, it took about 22 years to be implemented, and it's still not there 100%. So, you know, this is why you have to be to admit that this coordination is very difficult, because, you know, there are legacy systems, there are legacy interests, and they will determine the next steps, and you really have to coordinate from the get-go to sort of overcome them.
Thank you. So you made a good point there on, you know, it's not just about the monetary and financial system, but I do want to move on to the impacts on the monetary and financial systems. So, Cecilia, this one is for you, that some commentators have highlighted the risk that the introduction of a CBDC might lead to a disintermediation of the banking system in normal times, or if not that, at least in times of crisis, there could be a heightened risk in systemic terms of, say, bank runs during times of stress. Should we worry about these risks?
So that's one of the most kind of recurring question. And if I had not left my mobile phone outside the stage there, I would have taken it here and waved with it and pointed out to you all that I have all the access to my current bank accounts in my 2 Swedish banks at the tip of my finger. And I could make my own personal run from one bank to another as we sit here, but I can also exit the Swedish banking system, not into cash, obviously, but I can go for a very close substitute to central bank money, which is a mutual fund that invests in treasury bills. My point with this is that we already live today in a world where we can all run left, right, and center. And I think the interesting question is how much, if any, additional risk would the introduction of a CBDC be to the sort of run risk? So that's one observation. My second observation on this is that it's not exactly a sort of human right for universal banks to preserve the current funding model that they use. sometimes when you hear bankers talk about this, they say, well, you know, this is the way we fund ourselves, and we need a deposit base, and you can't introduce things that sort of threaten us. But if you look around in the banking system across the globe and from an historical perspective, there are many different versions and business models and funding models of banks, and they sort of move over time. And the banks are already now sort of competing for deposits, if I may call that, from e-money providers, from other versions of other players in the ecosystem. So we're already living in this system. And the disintermediation, if I may call it that, is already kind of happening. If the CBDC introduction, it's not in our interest for central banks to cause financial instability. I mean, most of all, after all, have financial stability departments within our organization. It kind of says something. We don't want to harm, but it doesn't mean that we are preserving the current banking models at all costs. We are in this to provide the public goods, and that means that if we do this, we're going to kind of do it gradually, or we can put in frictions. But I think it's a bit overblown, this argument against CBDC that it will cause a lot of run issues. All of this can actually be handled, and that's also been the conclusion of a number of governors, 7 central bank governors who've been looking into this. Yes, it could add possible changes, but it can be handled.
Yeah, thank you. So some of those trends are already there, and so it's not something that maybe we should be worrying about, and not even in times of stress.
We should be always concerned, but be watchful. But there are ways to handle this, both in a kind of preventive version but also in a more turbulent time. That's my opinion.
Do you agree?
I'm afraid I don't agree with Cecilia again. And I'm going up against all 7 of those governors when I make these remarks. First of all, if I take money out of my bank and put it into a money market fund, I don't withdraw reserves from the banking system. And in that respect, there's no disintermediation. The risk with central bank digital currency is a risk. The disintermediation risk is a risk that by withdrawing funds from conventional banks and money market funds, for that matter, and putting them in central bank digital currency, you're withdrawing reserves from the banking system, and this can have an adverse effect. The problem is that central bank digital currencies could pay a rate of interest that is actually above the rates that are paid by ordinary banks, and not because they're more efficient. Let me give you an example. In the United States, many of the proponents of Federal Reserve digital currency have been recommending that the Federal Reserve would pay the full interest rate on reserves, which is their equivalent of your bank rate, to the holders of these deposits. No bank can afford to pay that rate. It has to deduct its intermediation costs. It ends up paying a much lower rate. I don't say that banks pay as much as they should. There's monopoly power and all that. Nevertheless, you don't have the problem that digital currency pays more than other bank-supplied substitutes for official money. Now, this is a very real danger. In principle, in theory, the central bank could change the rate or adjust the rate it pays on central bank digital currency to make sure no disintermediation takes place. In practice, though, that rate can end up being a plaything of politics. And I'm going to give you a historical example, and it should give you pause. Before the Great Depression, and for some time afterwards, we had a postal savings system in the United States, and the interest rate on those savings accounts, postal savings accounts, was set bureaucratically. Now, until the Depression, it was not a terribly attractive rate. So banks didn't have any problem competing with the postal savings system. In the Depression, rates fell generally, as I'm sure you all know, but not the postal savings rate. And everyone who could was maxing out on those postal savings accounts and disintermediating from the banks, which was at a time when this was the last thing anybody wanted. Fortunately, there were caps on total postal savings accounts, maximum amounts per depositor. And it was only for that reason that the existence of those accounts and the rates paid on them didn't result in a still more massive disintermediation crisis. So one has to think of the politics here, not just not just a scheme of optimal interest rates that could be designed to preclude disintermediation, but the reality that these rates are likely to be informed by political considerations. And then the risk of disintermediation should be, it becomes a very real risk that central bankers should worry about. So I think that there is a danger here. I should also say, if you have a privately supplied, and I don't mean just privately administered, but privately supplied digital currencies, say with 100% backing of settlement reserves, or what we call master account balances in the United States, you wouldn't have the same problem, because then again, the private digital currency providers would not be able to pass on, even if they earned it, full interest on reserves. They would deduct their own operating and expenses. And I should add, just in case it isn't clear, the problem here is that central banks earn huge monopoly rents. Now they're earning a little less than, or a lot less than they usually do, but there's still there's a lot of fluff there. And they do cross-subsidize their services. They have the tremendous capacity to do that. So even if they're earning less on their portfolio, as is the case now, they can continue to pay interest on reserves that is not a reflection of their portfolio earnings at the time. And ordinary banks cannot do that. So there's a lot to think about here. It's not a problem to be easily brushed aside, in my opinion.
Thank you. So one, no, we shouldn't worry about disintermediation. One, yes, we should. John?
I'm a paid-up member of the Central Banking Trade Union, so this won't come as a surprise. And I think there are some jurisdictionally specific issues here. I don't know if there's anybody French in the audience, but I seem to remember the livret A in France. You have government-administered savings rates at certain banks. So if governments want to interfere with savings rates, they have plenty of ways they can do that. It's a societal choice, a political choice. Clearly in the US, the cursor has been put in a different place. And I just say, by the way, yeah, the Bank of England's profits on QE and the like go back to HM Treasury, and the seigniorage that backs the note issue goes back to US Treasury.
After your costs, though.
Pardon? After the cost of producing the banknotes. After the cost of producing the banknotes.
We have to return.
Well, many things are different across the Atlantic, I think, to other jurisdictions. I just wanted to make a number of quick points. First, just to endorse Cecilia's point, the balance between cash and commercial bank money has been changing in our economy frequently over the last couple of hundred years. When I grew up, most payments were in cash, most people were paid in cash, central bank money, and actually commercial bank money was much more limited. So this is not some sort of new thing. This is a balance that shifts backwards and forwards, and banks will have to adjust their business models. And I very much agree, it's not our job to defend particular business models. And I think in terms of credit creation, that is not something CBDC would do. So the credit creation aspect of this, banks issuing liquid liabilities against illiquid assets, I think would carry on. What we're talking about is when they create those liquid liabilities and they then leave the banking system, which is what happens when you take some of your money out of a bank in an ATM. That's exactly what happens. When those liquid assets of the banking system don't get redeposited in the banking system, but in a CBDC or a stablecoin, and actually a reserve-backed stablecoin would mean exactly the same thing. When that happens, okay, can the banks actually pull the money back into the banking system, which is what they need to do. And we published a paper about this time last year on some of the aspects of digital money, which looked as an experiment to see, well, what is the size of the, how many sort of bank liabilities would go out of the banking system? How many people take their money out of the banking system, put it into a CBDC? And then what would that do? Because the banks would have to pull that money back into the banking system by paying higher rates. One of the big problems with a CBDC, of course, and with a stable coin, whether it's reserve backed or backed with high quality assets, is we don't know the customer demand for it. This goes back to the iPhone. So half of the critics of CBDC will tell us that it will pull all of the money out of the banking system, and the other half will tell us there is no use case because the public don't need it, and it will pull out none of the money. And actually, it's quite difficult to say, well, what should we test? So the best proxy we could find was to assume that 20% of the sight deposits in the banking system moved out of the banking system and into a CBDC, into central bank reserves. We chose that number because that's the amount of uninsured deposits in the banking system. So people might think that the central bank is safer, therefore, I'll take out my uninsured deposits and the like. We also did some behavioral surveys on what people valued, safety and convenience, which pointed us as a cross-reference to the same number. This was all published last week. And then we ran a model, general equilibrium model, to work out, well, if that leaves the banking system, it's got to be pulled back. How much extra would the banking system have to pay? Because they'd have to pull it back for the wholesale markets. And what would it do to the cost of credit and the cost of intermediation? Numbers we came up with and the different assumptions range of between 20 to 80 basis points on the cost of borrowing if the money went out of the banking system and then had to be pulled back in again by banks attracting it. Now, there are lots of assumptions in the model, and you can run different assumptions. We can assume it's 100%, in which case I think it's a much bigger issue. We can assume it's zero. We have to be careful, and as we don't know the behavioral response, whether people will want lots of CBDC or a little, I think most of us are thinking, were we to introduce one, in the initial years, we would introduce one with transitional limits until we got a much better idea of how it will be done. But the idea that somehow if we do this, we will destroy the banking system, I think, as Cecilia said, is much overblown. And just on the question of runs and what could happen in a flight to safety, I mean, just as a general principle, and this is a personal view, I think if you're dealing if you have a problem with a failing bank, do you actually deal with the problem in the failing bank, or do you deal with the problem by preventing people to running to something safer? It kind of feels counterintuitive to say to people, we will block your access to safe assets so that you can't leave unsafe ones. Because that effectively is what we will be saying. We will be saying, we don't say to people, you can't hold more than a certain amount of cash, because that's safer than a bank. Okay? If you have a problem at a failing bank, and Cecilia is right, we saw actually with a bank in the UK, internet rumour that it was in trouble. It took about 10 minutes for the internet run to start on that bank about 3 years ago. So it's an incremental problem, not a new one. But if you have a problem at a bank, you have to deal with that problem in the end in the banking system. You have to deal with it with the liquidity. You have to deal with it with the access to central bank reserves, and if necessary, you have to deal with it with a moratorium, with resolution, with a gate. But there's something quite weird for me in saying, you know what, we don't want to give people access to something safe in times of crisis because we want to lock them into something unsafe. If you want to lock them into something unsafe, do it directly by acting on the banking system. And I think we've somehow got ourselves into almost a perverse backwards way of looking at this problem. So frictionless access to CBDC will probably make bank runs easier. It'll take out some of the costs. We see a lot of that at the moment. It may be a bigger attraction. But if we're going to address that problem, we have to address that problem in the way we deal with failing banks, not, I think, by blocking citizens' access to digital cash.
Thank you. Thanks. So quite a lot of views there, a lot of things to worry about, and some uncertainty there as to behavior and how things will pan out. Let me move now to monetary transmission mechanism. Raphael, if I can start with you here. How do you expect the introduction of CBDC to affect the transmission of mechanism of monetary policy? Is there any implication for our staff, for instance?
Thanks. I think that's an important question for this audience here, where we have a lot of academics who write on these issues. And I think there is sort of when I look at the academic literature and then I look at the policy discussions, there is a divide. And the divide is that, no, let's walk through the channels theoretically. I can, with the CBDC, I can apply a negative rate that I can apply to cash. I can change that rate. So not only can I break through the zero lower bound, but I can also apply monetary transmission directly. And then there is a debate on, you know, how risky the funding base of the private sector becomes. So that is right. Those are the theoretical channels, and we see a lot of papers on that. But when I then sort of go back to the policy discussions, they're of a very different natures. They start, and I think that's the sort of the quintessential argument has been made in this group of 7 central banks and BIS report on the core principles of CBDC issuance if an advanced economy were to issue one. And 2 of these core principles are coexistence with cash and do no harm to the commercial banking system. And there is a number of policy instruments that we can think about that can make this happen. We've talked about caps now with really caps. So for example, for the digital euro, 3,000 euros has been mentioned as a cap. They cannot be hard, right? Because then that would result in a broken payment system where some accounts are at the maximum and they cannot accept incoming payments. That can't work. But the ECB's Ulrich Binsal has come up with a very good proposal for a tiered one, where you have a cap and above that a very negative interest rate applies that will economically push funds back into the system. Or, and that is already adapted in the Bahamas Sand Dollar, every CBDC account has a linked commercial bank account. And if an incoming payment goes over the cap, which is I think $2,000, that automatically goes back to the commercial bank. So you can only hold $2,000 in CBDC. And all of these, you know, approaches have in the backdrop, we want to save payment vehicles that you could use in times of, you know, illiquidity or financial turmoil to do your retail payments. But we do not need a large safe store of value, right, that will disintermediate banks. So that is the policy debate. And if I now tie this back to these academic arguments, I think, yes, these theoretical arguments are there, but if I have a CBDC that coexists with cash, then the zero lower bound is still there, right? If I have a CBDC that sort of limits or, you know, has strong economic incentives to limit the overall outstanding amount, then the systemic implications will be small. And last, if the systemic implications are small to begin with, then also the sort of the flight into the CBDC is very contained. So that's why I think sort of we really need to sort of, you know, see these arguments of what could happen in the context of where central banks want to land. And then I see these effects as very contained.
Cecilia, would you like to comment on this question?
Well, so on what sort of monetary policy consequences from introducing?
Yeah, will it affect the monetary transmission mechanism in any way, either improve it or make it worse?
So hard to say, depend on design. Our starting point, when we started to look into this 6-7 years ago at the Riksbank, it was never about kind of improving kind of monetary policy toolbox. And just to go back to your comments, George, on kind of the risk for kind of overreaching political influence, central banks kind of growing out of proportion. You have a very important point there. Really, we don't. That's not the road we must take. Definitely not. So and one of the most important projects right now, when it comes to the e-krona in Sweden, is actually the politicians looking into this. What is the need? How can we kind of frame that? What would be the suitable legislation? Because this is not something that the central banks should just pop out introducing without a very disciplined conversation. So thank you for bringing that up. So our starting point, as I said, has never been about the monetary policy. We see it as a kind of as part of our objective, providing or kind of supporting rather a safe and efficient payment system. But introducing it, we have to kind of be mindful about the aspects. And for example, if it would affect the R star, meaning the long-term trend kind of level, where the policy rate is neither expansionary nor contractionary, we are always, when we have been struggling with too low inflation for too long, feels like a long time ago now, but we did that for a number of years. We of course are more interested in a high R star rather than low R star. And if you are successful, which we hope to be, in increasing the efficiency in payments, well then all other things equal, the productivity in the economy would rise, and that would be good for the R star. If we fail, then it's the opposite. But as I said, it's not a primarily monetary policy issue. We don't have a transmission problem in the Swedish economy, so that's why we sort of see this as very separate issues.
Thank you. I'm conscious that we are moving into audience Q&A time, so I'm going to ask a couple of quick-fire questions. So if you could just answer them in 1 or 2 sentences, please. First of all, are we likely to see CBDCs being rolled out in earnest in advanced economies over the next 3 years? John, starting with you and just moving down.
I think it's unlikely that you will see a full CBDC in operation in the next 3 years in advanced economies. Most of us think it's 4 or 5 years at least to develop one, test it, trial it. Remember, if you do a CBDC, it can't be like Terra or Luna. You know, it's got to work on day one, and it's got to keep working. We have reputations.
Thanks.
So China surprised us all, so I wouldn't be surprised if we get a bit surprised, but on the whole, I agree with John that probably a bit longer than 3 years, but I think we will see some pilots in advanced stages trying out kind of in a limited version within 3 years.
George.
Yes, I agree with Sir John also, having seen how long it's taken to roll out FedNow. And I think this could be much more complicated, even if it's just account-based. So I don't know if it'll happen in the United States, by the way, but I suppose it's probably going to happen in some advanced country in the next 5 years. The only difference I would add is I'm tempted to add an alas to that.
So I don't think that in an advanced industrialized economy over the next 3 years we could get a retail CBDC. We will see increasing experimentation on wholesale, maybe going into sort of production-ish stages. It could happen within 3 years, but I wouldn't be certain about it either.
Thanks. And then my last question, again, quick fire. Raphael, maybe starting with you, so we move backwards this way. Given that this is a conference and we've got a lot of young researchers here, what questions would you like to see researchers focus on with respect to CBDCs? What are the big open issues?
Well, I think, and we have a piece out at the annual economic review on this that really lines out sort of what the academic literature covers and where there are gaps from a policy perspective. And these are also, you know, gaps that sort of central banks should look at an operational level. I think it's really cybersecurity, very much related, offline resilience and privacy. That would be one important aspect. And then another important aspect is open systems. You know, in the end, if CBDC is sort of small from a systemic perspective, but has still important impact on market structure, it's via competitive channels. So how can you get that? How can you design an open platform that doesn't mandate technology, but that still creates an open and competitive ecosystem? So I think those would be the two things, and I'm happy to say that sort of at the Innovation Hub, we're already looking into these and that's really a coincidence, and the London and the Stockholm centers of our hub.
Well, my heart's desire would be to see central bankers spend more time researching digital currency, but not just central bank digital currency, and exploring the possibilities for private retail digital currencies and how they could be managed and regulated to serve the same purposes and perhaps others, and to do so safely particularly, I think they should be considering the likely extent of ongoing future financial innovation to be expected, on the one hand, from a system in which they directly compete with private sector firms, and on the other, from one where they leave the field open to those private firms without directly competing with them.
Okay, so most research we've seen have been kind of central bank and current financial system centric. So trying to look from the other perspective, using perhaps experimental economics, think about how to build and launch infrastructures that that kind of support innovations. And this is not any kind of market. This is in a market with strong network and economies of scales. So it kind of takes it's a bit demanding to look into what sort of infrastructure and rule book should you build in order to kind of bring out all the good bits that we want: safety, stability, inclusion, but also where the public sector doesn't play a bigger role than that is necessary.
So I think the area that's underdeveloped is behavioural. How people think about money, how they use money, different functions, what things make them use money and what money in certain forms rather than other forms, just to give us some idea of how this product, whether it's a private stablecoin or whether it's a CBDC, how this product would change the way transactions, the way people store their value, what they do. And actually we learn from some of the technology projects is it takes sometimes a very small change. Just the ability to use your watch, not your phone, and certainly not your debit card, unless you're very old-fashioned, to buy your cup of coffee, just can induce very large changes in behavior. And we don't really understand the way taking away little frictions can lead to big tipping points. So something in that area I think would just be very valuable as we explore this.
Great, thank you. So we're now open for questions, and what I'm going to do is I'm going to ask people to state their question, 2 or 3 questions at a time. So let's start here at the front. Just 1 second, wait for the mic to come to you, and then we'll go at the back over there. So start here.
Hello, my name is Kamal Shumba. I'm a reporter from CoinDesk, which is a crypto publication. And I have a few questions. So the first one is, so this is for the BIS. So what infrastructure would the BIS encourage to ensure there's interoperability between nations' CBDCs in the future? Because you mentioned a bit about that, Cecilia, at a conference. And then the next one is, so for John, you mentioned when we can sort of expect to see a CBDC in general, but just curious to know, like, when could we see like a UK CBDC, and like how long will that project take? And another one for the BIS. So essentially, what is the BIS doing next in terms of CBDCs for Cecilia and Raphael? Thanks.
Thank you very much for those questions. So one at the back there.
My name is Marcus Miller, and I have a question which I guess is really for Raphael Auer on the issue of the competition between the private and the public sector. Which hasn't been discussed yet. In a recent talk, Hyun Shin argued that there are, for cash, there are positive network externalities, but that's not true for private providers of stablecoin, for example, who actually make money when there's congestion or a shortage of the product. And in his view, this seemed to suggest that the private sector, unlike what I think George Selgin was arguing, would not be the optimal provider of the kind of new cash. So this is not a political question, it's an economic question. I wonder what the panel thinks about that.
Thanks very much. So I don't know, John, do you want to go first, or Raphael?
The UK question. So we've said that we can't see wouldn't expect to see a CBDC introduced in the UK before the second half of this decade. So that goes back to my 4-5 years timetable. We will, with the Treasury, because as Cecilia said, this is a political issue. So the Bank of England, the Treasury, will produce a consultation document by the end of the year on CBDC model. I wonder what the next steps should be, and that'll come out by the end of the year. But I couldn't see one being implemented, operational in the UK, certainly until the second half of this decade.
Let me answer the specific question on congestion by Hyun. I happen to know sort of what paper he had in mind, and I think sort of there is a confusion here. He was speaking about the limited throughput of blockchains and the economics behind it. This has nothing to say about, you know, a bank-operated payment rail or something. It's really about the fact that any cryptocurrency has, you know, for it's distributed, needs to be stored in many places, and it also needs to generate some income for sort of the miners that update the blockchain. And the only mechanism you have is that you make these blocks small so that there are capacity constraints, there are curves, and then people start to bid up fees. And that's sort of the mechanism via which cryptocurrencies generate income for the miners that make the blockchain secure. But that leads to sort of an overall rather limited capacity, right, in the order of magnitude of a few 100,000 transactions per day for Bitcoin, for example. So, but it is not an argument that relates to any sort of a centralized database run by a private firm. It's a specific argument to certain blockchains.
Certain blockchains is an important qualifier. That argument applies only to proof of work type arrangements like Bitcoin. The stable coins that are likely to the US dollar or British pound stable coins that would likely be alternatives to central bank digital currency wouldn't pose any of these problems. I suppose if somebody tried to design one like that, it would run into some stiff competition, and that would be that. But the externalities that come from currency itself apply to any currency that shares the same network that is compatible with the main currency of account. So what you want to encourage that with the private sector is to allow this compatibility to be as complete as possible, which means providing settlement accounts and letting them be integrated with the legacy payment system. And that's perfectly possible, and indeed it makes it easier to require private coins to be backed with high quality liquid assets and keep an eye on that backing.
Thanks. There were a couple of questions down here as well. 2 questions down here.
Hi, Tim Jackson, University of Liverpool. So CBDC would likely generate seigniorage, just as cash does, and it would, I'm guessing, mostly proposals for CBDC would be used to hold bonds, government bonds. So I guess, should we think of this as a good thing? Kind of the government or the central bank is earning seigniorage, we can then transfer to government, or is this a bad thing? I mean, how much of that does the effect of the fact that the central bank will be holding bonds in the long run because there is a demand for CBDCs and therefore they'll be holding a whole lot of stuff? How does that affect? What do you think about that, I guess?
Then there's one right at the front. Put your hands up if you have a question.
Thanks for a great discussion. My question was going to be about the regulation of private stablecoins. This was a theme in Nellie Lang's talk yesterday as well. I'd be interested in the panel's views, particularly if it's a horizon of 5 years plus before we see a CBDC potentially. There's going to be plenty of scope for innovation from the private sector. What do we need to see on the macroprudential regulation side?
Okay, so seigniorage being a good or a bad thing, well, in the same way as the Bank of England is sort of recycling its earnings back to the Treasury, it works the same for most central banks. And it's true that it is after cost, but we are always, as central bankers, at least in my impression, mindful that you mustn't let the costs run away, because then you will get some difficult questions from your masters in your parliament, so you have to restrain that yourself. I think, Dave, you touched upon this issue of regulation of stable coins. There is a flurry of different work groups looking into this. But this takes time. This takes a lot of time, actually. So let me just point out one thing. The global financial crisis, it was pretty clear what needed to be mended then in terms of regulations and supervision. Does anybody know how many years it took from the actual crisis until the last part of that regulation is being fully implemented?
12.
I'll give you the answer. It's 25 years. It's quarter of a century. So, you know, it takes time. A number of countries needs to come together, and it gets further delayed by a flurry of lobbyists and then domestic vested interests. So don't over-believe what regulation can do, because it usually, a lot of troubles could have happened in the meantime.
So on the centerage point, the only point I'd add is, what's your counterfactual? Is your counterfactual a payment through a credit card company that is costing 140 basis points for a small merchant in the UK and probably closer to 400 basis points in the US. So you look at why some of the payment companies are the most valuable companies in the world, and you get some idea of the rents that can be charged through payment systems. It's truly astronomical. On the question of regulation of stablecoin, 2 points. One, the international committee that I chair, the CPMI, has issued consultation, or will issue a final, on how the international standards for systemic payment systems, think of it as the equivalent for payment systems of the Basel standards for banking, how they should be applied to stablecoin. And that includes, what should the backing assets be, what's the redemption, what's the claim, how do you ensure that if a stablecoin is being used as money in payments at a systemic level, it's safe. I hope we'll put out the finalized guidance on that before the summer break. So internationally, Cecilia said it's slow work, but we've started on that. That will be for single currency stablecoins. There'll be more coming on multi-currency. For the UK, well, I know I would have said yesterday. Can I say it today? I think I can. So for the UK, the Treasury have said that they want to introduce legislation on creating the regulatory system for stablecoins, private stablecoins used in the UK. And I think they were aiming to do that before the summer break. I mean, it may get a bit delayed by some events that have happened recently. But the consultation has been out there, the response is out there, and that will give the Bank of England the power to regulate systemic stablecoins, and the Financial Conduct Authority non-systemic. The Financial Policy Committee of the Bank of England has said very clearly that we don't think that you have to be a bank to issue a stablecoin. And we've also said that the only two backing models we can envisage as safe are backing with very high quality liquid assets or backing with central bank reserves. So we actually are thinking very strongly about central bank reserves and how does that work? Not as an alternative to CBDC, because I think we believe in a mixed ecosystem and different forms of money as we have at the moment. And if that legislation proceeds on that timetable, sometime around the end of this year, we'll put out a consultation on the regulation of stablecoin used in the UK at a systemic level, because we're interested in systemic. And I think, David, that goes to your macro question. But actually, the expectation that the Financial Policy Committee set now 3 years ago is the guiding light, which is if you're used as money at systemic level, then you have to offer people the same level of robustness as commercial bank money or central bank money. And you may have to get there in a different way, but people have to have the same confidence in its stability and value, creditworthiness, as they have if they're using central bank or commercial bank money. And that'll be the test for us.
Thank you. Do you want to make a quick point?
Do I have time?
Yeah.
I'll be quick, because I first of all, I think the approach to regulation, as Sir John described, is very sensible. I think the main thing is that private stablecoin issuers, of course, first of all, they should be safe. And that means that if they're not banks, they have to have very strong reserves. I don't see any other way that's going to be practical. And but I also think it's very important that the arrangements, the regulations be such as allow non-banks to take part, because they're the pioneers in this area. And banks, many of them, frankly, are not interested in competing. So I think that those are the main ingredients. You want competition, you want rivalry, and you want safety. And so I hope we do something like what you're promoting.
Thank you. So final round of questions. So please put your hand up if you've got a question. One here.
Can you hear me? I wanted to ask about the numeraire. So if cash is disappearing and if CBDC doesn't come in, then what is the numeraire? I'm a bit lost. I'd love you to talk about that.
Question from the top.
Hi, Varun Paul. You talked about CBDCs being some years away. You talked about interoperability, but you also said we might build, so John, you said might build account-based rather than token-based, and Raphael, you said there are still some projects building on traditional architecture. So how do you square those two things? Are we building for the future that is interoperable, or are central banks building a technology that in 5 years' time will have been innovated by the private sector?
I think this is, what is the numeraire? That is such an important question that we don't think about enough. What anchors our thinking about what money means to us? And it's a, it's a question, it's very abstract, right? But it's very important because when you think about what you do in your life, right? You have a job and the primary purpose is to get that many units of that numeraire because you can relate to these units and it will give you, this consumption stream. And with cash, it's a physical incarnation, and it makes sort of this abstract concept much more tangible. And that's, if you think about the history of central banking, the standardization of cash has been a major building blocks, right, in their history. And that's why also sort of, right, central bankers really think that this could be an important function of CBDC, just to anchor our understanding of what 1 unit of a pound means in the consumer's mind. And that is, it sounds a bit abstract, but it's really important when you think about how just knowing this yardstick, what does 1 pound mean to me? And where do I allocate my expenses? When do I decide to work or not? Or for what job do I go? All of that, imagine how difficult it would be if you had to weigh it in loaves of bread and iPhones and so what. So I think this is, it's a quintessential question. And even if it won't be paper-based, it will still be sort of a central bank digital standard that could come in a certain visualization and in a certain access format. And it would pertain some of these criteria as much as you can.
This is what I would search. So what I'd say is there is a school of thought that says the public does not need to hold a central bank asset to have confidence in the numeraire. Central banks do their job of maintaining the value of the currency, okay, a bit challenged at the moment, but we're doing our best. Then people will have confidence in that numeraire, so long as the private sector banking system is required to transact in the numeraire, i.e. settle across the books of the central bank, they will then use the numeraire and it will go down. There's another school of thought that says, actually, there's something about the symbolism of holding the safest asset, the state asset, that underpins some of that confidence, which is the point you're making. And if people eventually realize that they can't hold the numeraire in its purest form, then in a crisis or whatever, you could get a loss of confidence in money. And there's really no way of knowing kind of how that functions behaviorally and psychologically, which is one of the reasons why I think it's a kind of area about how people think about money and what's important that really matters. But look, you have dollarization at the moment, and if people lose confidence in what is behind money, the institutions of the state that are behind money, then you'll get digital dollarization. People will leave the currency and go to another currency. But I think there is a question about how close do the individuals in society need to be to central bank money to have confidence in the monetary system as a whole, and that's a motivation. So.
I mean, this, of course, goes back to Adam Smith, who believed that it was desirable that the public should be made to continue to hold some species, silver coin, even as banks in Scotland were capable of completely substituting their IOUs at that time, they were very good at it. But he thought that there should be limits on the size of banknotes, no small ones, so that some coin would remain in circulation.
Very, very quickly to the question of the gentleman up there. So, without going too much into the details of account-based, token-based, DLT, not DLT, I think the job here is to build infrastructure that is agile enough to kind of move with time. If you look at any kind of transport system, electricity, telecommunication, RTGS systems in central bankings, that's what we do, really. We kind of evolve and rebuild over time.
So I did say it was the final round, but there's one more question here. If anybody else wants to put their hand up, this is really your last chance.
Anna Stavpova, National Bank of Ukraine. And I have a question, how you can assess the situation regarding the implementation of financial monitoring that prevents money laundering through cryptocurrency in terms of the issue of update sanctioned list of Russian citizenship? Thank you.
Just pass. Take that one quickly.
Thank you. I have a question, or two questions. So currency is older than the Bank of England. It's even older than the Riksbank. It hasn't really been updated since then. The use of it is pretty much the same software version, if you will. And now we're talking about really the biggest software update. And it's that you can transact currency far between. That's the huge thing. So the first question is, why do we need to build more updates into it, such as, do we need to pay interest on currency? Do we need to monitor what's going on with the currency? So why are we complicating it at this time? It is. The second question is, and it's, because it's interesting to compare Sweden and the US, where Sweden has seen currency come down dramatically, while the US has seen it go up significantly. Mainly the $100 bills that you don't see, but it's 85% of all the bills. So I studied in both Sweden and the US. Interesting thing in the US is it's really costly to be poor. If you have less than $1,500 in your bank account, it costs you $10 per month. So it's maybe that sector of the economy and the importance of that for central banks to step in and create one currency for everyone.
Thank you. So very quickly, who wants to go?
So very quickly, there is a lot of difference between George's country, which is more of a continent really than a country, and mine. But be mindful, it's too crude just to look at the money, the value in circulation, which I'm sure goes up in most countries actually, goes down. You have to look at what people are actually doing with their money, and I'm pretty sure that also in the US, digital payments are kind of skyrocketing versus cash payments. And I think a lot of central banks came to me when we were starting this project. Why are you doing this? Because they were seeing their currency circulation going up. When they looked at the payments in their society, I think that goes for the United Kingdom, for example, they came to the conclusion they were just a couple of years behind Sweden. And once people have changed behavior, they don't go back. And I have to say, the last thing I say, George, you said in your first intervention that cash will not stop to be accessible in the United States. I think if we sit here in 10 years' time, you will find that also dollar cash will have stopped being accepted as a payment method in great many parts of the US. Future waits for no one, not even American citizens.
Yeah, I've been wanting to agree with Cecilia all night. I do agree. People could get cash, but they would have trouble using it. And I think that's right at some point in the future. I want to take advantage of the gentleman's question, the first question about banknotes and all that, to say that I think we should consider how long it's been since we've had an update on currency. And I think it's, I know I might have to get ready to run, but I think it's a consequence of the fact that it has for practically a century and more in some places been monopolized by central banks, and they don't have the incentive to innovate. This is controversial, but I think if it had been left to private sector banks, they would have moved out of paper a long time ago. You know, it's like the post office and stamps. So now we've had non-bank firms that have intervened and created this new sort of currency and inspired central banks to get on board. But I think that all of this speaks to the importance of having an industry where there's ongoing competition, so we can update continuously to whatever the best technologies for payment happen to be.
We're actually out of time, but 30 seconds.
Now, I'm confused. Do you want us to evolve the future of money or not?
Yeah. Yeah. Well, I want the private sector to be playing the leading role.
Okay.
John.
First of all, I think technology and money has been changing remorselessly for the last 150 years, and we've had huge political debates about it every about 100 years and the like. So I don't sort of believe. Well, if you think about money as used in payments, and I just think about what's happened in my lifetime, certainly it's a very different world to the one I grew up in. On the Ukraine question, I think a number of jurisdictions have issued strong guidance to the exchanges, the on-ramps and the off-ramps, for Bitcoin and others, about the importance of sanctions and the fact that you're digital and crypto doesn't mean that sanctions don't apply. Of course, the underlying problem is the anonymity with which people are able to transact through certain cryptocurrencies. The evidence that one can amass is that this has not been a material route for getting through sanctions, in part because something that can lose 70% of its value in a week is probably not a very good way of moving assets around the system. But probably some has gone on, and this just to me underlines the need to bring these technologies into regulation so we can get the benefits of them and the benefits of competition, because I do believe in competition in money and payments, without some of the social harms that can come from the sort of thing we see. But
Thank you very much for your questions, and a massive thank you to the panel for their time. Thank you.